Now, if we think about the economy, that's not going to get a lot of drama going, except for last year, with inflation at near record highs in our lifetime. It was a pretty traumatic experience for American households. We saw negative real wage growth for workers in America, and for retirees who are usually on fixed pensions and who are depending upon their savings to maintain their standard of living. Last year was a particularly horrific year. And that increase in inflation, driven by the sheer magnitude of the stimulus spending on the back of the pandemic, really caught our policymakers offsides, and in particular forced the Fed from going from a position of being incredibly accommodative to, in recent months, rapidly raising interest rates at one of the fastest paces ever to try to put the inflation genie back in the bottle. Now, when you manage money, you make money by having a difference in opinion as compared to the broader market. And for us, the difference in opinion that we had was that inflation was going to be very hot, and it was, and that was a source of revenues for us last year. This year, I'm actually really pleased that we're not far away from consensus on inflation. The market overall thinks inflation is going to head back towards the upper twos in the foreseeable future, and we are not materially different than market consensus at this point in time. So I truly hope that the market's right on this call. January gives us some pause for concern. Labor market red hot in January. We don't know how much of that is the weather effect. January was unseasonably warm. We're going to know a lot more in a few days when we see the February payroll numbers, which we expect will be much closer to 200,000 in growth versus 500,000 plus in January. That'll give the Fed a bit of comfort that they're getting the job done of cooling the economy, bringing down inflation, and putting that pretty evil inflation genie back in the bottle.
Mm-hmm. But then what's your take on what Jerome Powell said today, that the Fed was prepared to increase the pace of rate hikes and that the terminal rate is likely going to be higher than previously anticipated? A lot of people are reading that as a sign that they're going to go faster.
So he created space today to move by 50 basis points on the next hike. You know, they'd come into this year pretty clearly telegraphing that 25 basis points was going to be the per meeting rate hike for the early part of the year, and then in some sense, taking the foot off the brake and seeing where the economy lands. And in fairness to the Fed, the interest rate tool as a means of controlling inflation it's like having surgery with a dull knife. It is a really difficult tool to get the job done with, because you hit the housing sector, you hit the manufacturing sector, you hit parts of the economy that have a very high sensitivity to interest rates, and you tend to leave the rest of the economy relatively untouched. So the Fed doesn't have as much impact with their tool as you might hope, and although they've raised rates considerably, it's not clear how long the lag effects are for the impact. And once the impact starts to play out, how damaging that impact is. So they're in uncharted territory. It's a difficult place to be. If I could tell one thing to the chairman, I would tell him to say less. I would just be write a message. We're going to put the inflation genie back in the bottle. We're going to do what it takes to make that happen, and we're going to raise rates consistently until we see very clear evidence that we've put this behind us. Because every time they take the foot off the brake, or the market perceives they're taking the foot off the brake, and the job's not done, they make their work even harder. And at the same time, remember, they're impacting in a very, very harsh way a very small part of the economy. And that's really tough for those businesses that live in that part of the economy.
So you're talking about the damage. Do you think we could see a recession this year?
So we have the setup for a recession unfolding. What we're seeing is that the American savers did what you'd expect. The American consumers did what you'd expect over the pandemic. They were handed enormous amounts of money by the government. Most were able to keep their jobs because of work from home and otherwise. And let's be clear, you couldn't go out for dinner with your friends, you weren't traveling, so you saved money. Yep. And the American consumer saved trillions of dollars. Now, the flip side of this is the US government spent about $5 trillion over the pandemic. to allow us to stay at home and sit on the sofa. Put $5 trillion in context, we spent about that much money in real terms in World War II to win World War II. We spent as much money in the war against the virus as we did to save the free world in the 1940s. And that money that went to American consumers has been coming back into the economy post the vaccinations, post the reopening of the economy, and it's been spent at a torrid rate. Best guess, there's about $1 trillion change left of excess savings that's being spent at roughly $100 billion, $120 billion a month, which means by the end of this year, in some sense, the punch is out of the bowl. And that makes next year, late this year, a very interesting transition point as this post-pandemic orgy of spending comes to an end. And then we'll see the true strength in the economy, and that's going to be a really interesting moment in time.
So you promised drama, and as of now, we had the orgy of spending and the dollhouse knife surgery, which I thought was a lot of drama already.
We like the doll knife one, yes. Yeah. And I do think that everyone has these very high expectations that the Fed can just work magic on inflation, and they don't have it that easy. And that's why I really believe that the consistency of messaging is so important, because part of how the Fed gets the job done is the perception of the American public that they can get the job done. Right? Inflation has a significant component around expectations. If you think prices are going higher, you're going to be much more demanding in your wage negotiations as a union, for example, or as an employee. You're going to really be focused on how to get your wages up as fast as you can because you see the bills coming your way. When the Fed breaks expectations of inflation, it does wonders in terms of helping make the economy work better.
Do you think they're doing a good job in framing the message?
No, I think the variance in the message over the last couple of weeks has been incredibly counterproductive.
Okay. And what do you think is the terminal rate ultimately? I mean, how far are we going to get and how long are we going to stay there?
The markets are pricing in that we'll see Fed funds somewhere in the mid-5s. That's probably about right. And of note, the market predicts that by the end of next year, we'll have cut rates by 200 basis points. So the broader financial markets thinks that we're heading towards a very sharp peak in rates in the months ahead, followed by a period of relative calm in rates, and then a pretty fast cut in rates throughout 2024.
Is that your perception as well, or no?
I think that's probably a pretty fair assumption as to how the market's going to play out. We are going to hit this moment in time where clearly inflation is decelerating and the punch bowl being empty. We're going to see the economy start to slow as demand fades away.
So we're running a big story on Bloomberg today about how markets are basically shrugging off the risk of a debt ceiling standoff. At which point do you think that becomes a relevant theme for the markets? Is that risk underappreciated?
So regretfully, there is very little common ground between the two parties that are in power today. In fact, I'm not sure there's any common ground between the two parties that are in power today. And as such, unfortunately, it will probably not be until we have the volatility in the market that goes with an impending default that we will actually see cooler heads prevail, a compromise reached to kick the can again to the typical budget process where we'll see, I think, the real contours of what the magnitude of government spending cuts will be and or the nature of tax increases will be. So I think the debt ceiling will be a non-event until it is an event. That event will shake the confidence of the House and Senate. They'll find a common ground to kick the can again. They're very good at that. It's a national sport. And then we will address this in a haphazard, mediocre way later this year in our routine budget process.
But there will be a compromise.
I mean, God willing. And I do think it'll be the market volatility that will drive that compromise to kick the can. And the reason we have to do this is America owes about $30 trillion today. And if we defaulted on our debt for even a minute, the increase in interest rates that we would pay for decades to come would cost our economy dearly. I mean, if you think about it, if our current $30 trillion of debt had to all be refinanced at today's prevailing interest rates, we would spend about 6 2/3% of total GDP just servicing our debt. That means you'd start work in January, and by roughly the second half of January, having had no money to take home, you would have worked long enough to pay the interest bills for the year on the US debt.
You mentioned that one of the ways Washington was trying to carve out a way of this was tax hikes. In fact, President Joe Biden said yesterday that he was considering a tax hike in incomes above $100,000, right? So do you think that's the right policy? That's the right way to go?
So the Democrats are very enamored with the political talking points of raising taxes on the rich. And that works for a very brief period of time, but there's just not enough money there to pay the actual bills. And so unless we are willing to bring spending under control, we're looking at tax increases for all Americans. You know, in Illinois, for example, which has a chronic deficit spending problem, unfunded pension plans in the hundreds of billions of dollars, they haven't been able to raise income taxes yet, but they've raised almost every other tax you could ever imagine, from gas to property. And those taxes actually they're not paid by the wealthy as much as they are by the people who are in the lower class and middle class. They're incredibly regressive. So if you look at a state like Illinois, which prides itself on being so progressive, and then you look at where the tax burden actually falls as they continue to try to put their balance in budget, it falls on the very people that government claims to be entrusted in protecting. And so what I'm worried about is that the talking points are cheap, the political victory that comes with it is cheap, but the hard work comes from having to have the real tough decisions about where to cut spending. And of equal importance, how do you take the tax base and broaden it and not just find taxes that disproportionately affect people in America that are living paycheck to paycheck trying to make their bills happen?
You mentioned at the beginning of our conversation that your vision for inflation doesn't differ that much from the market. What exactly how are you positioning with the fund right now? Like, where are the biggest opportunities for a hedge fund like Citadel right now?
So we are constantly positioning our capital against where we have a differentiated view as compared to the market. So for example, if we think a company is going to announce strong earnings for a quarter that others don't anticipate, and perhaps guide for stronger future results, we'll be long that stock.
So where do you have a differentiated view now?
Right now, I would say it's fair to say that we're somewhat licking our wounds from the incredibly strong economic data in January.
Really?
So we did not anticipate that we would see such strong economic data in January, and that's forced us to reevaluate our interest rate and inflation positions here in the United States, or for that matter, around the world. And part of what we do, I think, very well as a firm is we accept reality, which is, wow, we didn't see this payroll number coming. We didn't see the inflationary print that went with this. We've got to go back to the drawing board and rethink our framework and redecide how to deploy our capital. And we'll do that for a couple weeks, and then we're back at it. But very successful investors are very quick to acknowledge when they've got it wrong. And they don't let, I think of it as like thesis creep come into play. When you're wrong, you're out, you reevaluate, you decide what to do next. And that can sometimes mean doing the exact opposite of what you were doing just 8 weeks ago. And in particular, with rate markets around the world as volatile as they are, we are constantly changing our position from long or short rates in various countries around the world, like every couple weeks.